Welcome back. So there are a lot of misconceptions out there about credit scores. What goes into them? What helps? What hurts? And it's actually a rich get richer item because if you make good choices to help your credit score, it helps you save money, which in turn helps you maintain your score. That's why today we're going to break down the 5 categories that make up your credit score, as well as debunk a lot of just bad information that you might have heard over the years. And with this information, it's not actually that difficult to get your score over 800. But if there's one easy thing you can do that's going to help improve your credit score, it's press the like button for the YouTube algorithm. We're also going to do a little bonus presentation throughout this video. And I have my son Cameron here, and he brought out his favorite Nerf guns, and he's actually going to show how certain actions can really not hurt your credit that much, and in certain cases, hurt pretty bad. You ready? Mm-hmm. All right. Now the first section is new credit, aka credit pools. Look at that, nothing happened, because it's actually not that important at all. You see, new credit only encompasses 10% of your actual credit score, yet it's taught like one hard pull is a massive deal that's the financial equivalent of a severe concussion. Now, a better analogy would be like a workout at the gym. Now, you might be sore for a day or two, but the long-term benefits of exercising are going to far outweigh any soreness that you deal with, and you're never going to get in shape if you don't exercise. One hard credit pull is likely to drop your credit score somewhere around the neighborhood of 5 points, because it's just one data point on the smallest factor of your entire credit score. And that hard credit pull is going to really stop hurting after a matter of a few months, and it's off of your report from a scoring perspective within 1 year and off altogether after 2. It's completely gone. Now let's take a look at the general guidelines for what's considered excellent to poor when it comes to credit pulls from one of the best credit tracking and budgeting apps out there, Mint. So 0 to 1 is considered excellent, 2 to 4 is considered good, 5 to 10 is considered not bad, and then 11 and anything over that is considered poor. But remember, this is based on a 2-year period, and anything after a year doesn't affect your score anymore. It's just a footnote. So to sum it up, 1, don't be afraid of a credit pull. Now you want each one to have a purpose, but there shouldn't be a reason why you choose not to do anything, because you have to exercise to actually get in shape. And really after about 2 to 3 months, your score readjusts to what it was to begin with. And 2, just don't have too many of these before a long-term loan. Now this could be an auto loan, but more importantly, a mortgage. I would want to avoid any hard credit pulls within 6 months of these events, and probably no more than 2 to 3 within 1 year. Just because this is really the financial equivalent of the Super Bowl, and we don't want any of that soreness, to use our gym analogy earlier, still carried over, because a small rate reduction by having a great credit score can make a big difference in the savings for a long-term loan. Now that we've talked about the biggest misconception, here's the actual most important factor: payment history. Now this encompasses 35% of your score, and in my opinion should actually be higher. And see, the whole point of a credit score is to understand if you're going to pay back debt, and this is literally the history of you paying back debt. Now the great thing about this one is it takes absolutely no time whatsoever to get a perfect score. You get your first line of credit, you pay it off after the first month, you have a perfect score, you're done, yay! However, if something does go wrong, let's show you the breakdown according to Mint. 100% is considered excellent, 99% is considered good, 98% not bad, and 97% and anything below that is considered poor. Now, not a lot of leadway here, but like I said before, this is literally the history of you paying off debt. What I would suggest is that any account that you want to have it on auto pay, just because you don't want to be distracted and forget one payment that can ruin your score for the next few years. Now let's clarify what these percentages mean, because the math might seem off if you have more than one line of credit. Now let's say you've had one credit card for 1 year. Now over that entire first year, you missed one payment. So that's 11 out of 12 months successfully paid for a percentage of 91.67. Now, let's assume you had 3 credit cards, all open for that exact same time period of 1 year. So in this case, it would be 12 plus 12 plus 12 for a total of 36 months. So with 3 cards, you actually successfully paid in 35 out of 36 months for a percentage of 97.2. Even though it was only over 1 calendar year. So you can see is actually having more credit lines helps you improve your score if you ever make a mistake in a faster period of time. Now I will say that a minimum payment does count as a successful payment as far as the way your credit score works. You don't have to pay off the full statement balance. However, I'm just saying that for information purposes. You should always pay the statement balance so that you're not paying interest. So I feel kind of dirty talking about it, but just for the information, a minimum payment is all that's required for your credit score. So to sum things up, as soon as you pay your first month on your first line of credit, your score for this section is completely perfect. All you have to do is just maintain it. The more accounts you have open, the more accounts that can have successful payment history and allow you to catch up from a mistake much faster, which is another reason why we shouldn't be afraid of credit pulls. And if for some reason you get into trouble, technically the minimum payment is considered a successful payment for credit score purposes, But if you're going to go this route, you really should rethink if you should have a credit card. Now, the next one is right in the middle as far as importance, and it does have a bit of a loophole that can be exploited, and that's length of credit history. Now, this category encompasses 15% of your score, and it's simply just an average of the total years of all of your currently open accounts and then any accounts that you have closed within the last 7 to 10 years, depending on the type of credit. As a very simple example, if you had one credit card open for 1 year and then chose to get a second, the two together would now average out to 6 months. Now let's take a look at the breakdown based on years. Now 9+ is considered excellent, 6 to 9 is considered good, 3 to 6 considered not bad, and anything under 3 is considered poor. So when I went to buy my first car, the car salesman there actually gave me a piece of advice, me the young kid still trying to build my credit. What he suggested was, I need to finance my car out for as long as possible. That way it shows on my credit report for as long as possible, which would help me build my credit, which is absolutely terrible, horrible advice. You see, when you pay off a large loan, like an auto loan, mortgage, or student debt, it'll stay on your account as a closed account for 10 years, which is still going to increase your age of credit. So there's no reason why you should actually continue paying off a loan and paying additional interest, because it's just not worth it. But once you hit that 10-year mark, it could drop off your report, which will then lower your score. But by that point, hopefully you'll have other trade lines that are set up, so it won't be that much of an impact. So to sum things up, each time you open a new line of credit, it is technically going to lower this part of your score. But it does remind me of the old phrase that the best time to plant a tree was 5 years ago. The second best time is today. If you want to bump this up, what I would suggest is getting yourself a really good core of no-fee credit cards. Take the hit now and keep those accounts open forever. Now the next thing is, we might actually be able to hack this one a little bit. Now I mentioned this in a previous video, but if you have a parent or a family member that you can be added to as an authorized user that has a card with a good payment history and a long length of credit, you can get added on there, never receive a card, and let's say, for example, they could have had this card for 20 years. You've now bumped your length of credit when you're getting started up to 20 years. So as you're getting your own core of starter cards, it is going to lower your average, but you've got a great cushion to get started and allow you to actually qualify for a lot of different things and also maintain your score. Now, on to the second most important category, credit utilization. Now this number is calculated by just taking the total of all of your current transactions divided by your total credit limit. So if a credit card has a limit of $5,000 and you've spent $2,000, your credit utilization is 40%. Now, one misconception I want to get out of the way right now is this is not utilizing your credit by not paying off the balance every single month. I once got in an argument with someone about this that said that the best way to improve your credit score is to always maintain a balance and pay interest, because then the banks will actually give you a higher credit score because you are utilizing your credit. No, you're just wasting money. Now let's take a look at the breakdown. 0 to 20 is considered excellent. 20 to 40 is considered good, 40 to 60 considered not bad, and really anything over 60 is considered poor. Because your spending should stay relatively the same due to budgeting, the best way to improve this section of your score is actually just to have multiple lines of credit. So if you look at our example earlier, we had your same $2,000 to spend, but instead of one card with a $5,000 limit, you had 3. Now you're looking at $2,000 divided by $15,000 for a utilization ratio of 13.33%. With this category encompassing 1/3 of your entire score, it's worth continuing to open new lines of credit over time, as well as continuing to keep open old accounts you're not even using just to keep a higher credit limit. Now there is a little hack that we can do to get your score up here a lot faster if you don't have a lot of available credit, and that's paying things early. Now the way auto pay works, it actually doesn't pay until the end of the following month from your transactions, so you can have 2 months of billing at the exact same time. So to fix this, all you need to do is just go on manually and pay off your full balance as soon as that statement posts, or if you want, even in advance. Now, if you're on auto pay, it's not a big deal. Just let it run its cycle, don't worry about it. But if you need to get a quick score, you want to maintain it really high because you got a big loan coming up, just pay things early, and that way when they're reporting to the credit agencies, your credit utilization is really low. So to sum things up, the more credit, the better. Anything you can do to get your credit limit up is going to help your score, but you should never spend based on your credit limit. That's your budget. If they just want to offer you the potential to spend more, you take it because you don't even care, it just improves your score. Another thing to look for is that many credit card issuers are willing to increase your credit limit on an annual basis. Now you got to make sure they don't do a hard credit pull, because then it's not necessarily worth it as much. But if they're not going to do that hard credit pull and they're willing to increase your credit limit, you're not going to use it anyway. You're still using your budget, but it's only going to improve your score, so it's worth the phone call. And lastly, if you need a short-term boost, don't wait for auto pay. Pay early, pay throughout the month, and that way when they report to the credit agency, you're going to have a lower use of your available credit. Now, our final factor is credit mix. Now, this section only encompasses 10% of your score, and it's simply just a mix of the different kinds of loans and credit cards that you have. So what we're really looking at here is the difference between installment loans and revolving loans. Now, installment loans are things such as auto loans, mortgages, student debt, where the monthly amount stays relatively the same, versus revolving loans, which are things like credit cards, which have a varying balance. So back to Mr. Car Salesman. He also suggested that I should get a personal loan to go with my auto loan. Now, at the time, the interest rates on those personal loans would have been somewhere around 8 to 9%, but he thought it was worth it for me to pay the bank back all this interest because my credit score would be fantastic. Was he correct that having a personal loan would improve my mix of credit? Technically, yes. However, that one item is just one data point on a category that only encompasses 10% of your score. So now I just get to pay the bank 9% interest. Man, I hope it doesn't work there anymore. Now let's take a look at the chart. Now anything from 22 and up is considered excellent. From 13 to 21 is considered good. 6 to 12 is considered not bad. And anything from 5 and under is considered poor. Now you might look at this and say, how am I going to get 22 accounts? This is going to take forever. I need to start applying for every loan and credit card that I can see. Just pause for a second. If you need to get an auto loan, okay. And if you're ready for a mortgage, that's great too. But it is so insignificant that it should not be a factor in how you budget, save, and invest. In summation, credit mix is just the total accounts that you have open with a little bit of a mix of installment loans versus revolving loans. And this category is fairly insignificant when you look at credit score as a whole. So don't do anything rash and just build your accounts up over time. And with credit cards, just keep old accounts open just because it's only going to help improve your score. Now, some people are afraid that if they don't spend consistently on their card, the bank might close it. So in my experience, what you can do is just buy a 50-cent Amazon gift card once a year. As long as you're spending on it once a year, usually you're in great shape. And then when you're not using it, just put a security lock on it. That way you don't have to worry about fraud and put it back in the closet till next year. If you got this far in the video, please like and subscribe. It makes a big difference in the YouTube algorithm. And if you don't like the next one, then you can unsub. But hey, let's just give it a chance because you got this far, so clearly you like something about it. We're going to be talking about more on credit cards, bank hacking, retirement accounts, investment accounts, and not paying taxes legally. So if you liked it, please once again, like and subscribe and hit that little bell so you're notified in the next one. If you don't like the next one, then you can unsub. Thanks for watching.